All right, let's dive into a real head scratcher from the stock market. We're looking at a company called Jyoti Resins and Adhesives, and it's a story of a massive contradiction. On the one hand, it looks like a spectacular success, but on the other, the market is treating it like a total failure. So what is really going on here?
I mean, check this out. This really lays out the puzzle perfectly. Over the last 3 years, the company's profits have just exploded, up a massive 59%. Now, you'd think the stock would be shooting for the moon, right? Well, it's actually down 12%. This kind of disconnect is exactly what makes investors start digging for answers.
And that brings us to the big question, doesn't it? What is the market so scared of? What kind of hidden risk could possibly be powerful enough to completely ignore that incredible profit growth? Well, let's find out. To really understand the fear, you've got to understand the hype first. So we're going to start with the good stuff, the bull case, the story that makes this company look like an absolute home run. Just take a look at this 12-year journey. It is nothing short of extraordinary. If you go back to 2014, revenues were just 15 crores. Fast forward to today, and they're pushing 300 crores. And the profit after tax, it went from practically nothing to over 70 crores. I mean, that is the textbook definition of explosive growth. And we're not just talking about growth for growth's sake. This is incredibly profitable growth. At its peak, the company was hitting an operating profit margin of 33%. Now, to put that into perspective for you, the industry average is usually somewhere between 15 and 20%. So Jyoti Resins was operating on a whole different level of profitability compared to its peers. So how in the world did they pull this off? Well, this quote from the analyst report explains everything. The company made a really brilliant strategic move. They stopped just being a middleman, a simple distributor, and they started building their own powerful brand Euro 7000. That move is the entire foundation for the bull case. It was a total game changer. And if that wasn't enough, the company's financial health is an absolute fortress. They haven't had any debt on the books since 2018. And get this, they are sitting on a massive cash pile of 170 crores. Think about that. 17% of the company's entire value is just sitting there as cash in the bank. From this angle, it looks incredibly safe. But if everything is so perfect, why on earth is the stock down? Okay, let's flip the coin and look at the bear case. This is where we uncover the one single issue that explains everything: a critical problem with cash. The analyst report hones in on one critical red flag that basically overrides all the great news we just talked about. And this slide right here shows you the problem in black and white. For the last fiscal year, the company reported a profit of 74 crores. Looks fantastic, right? But the actual cash, the real money generated from its operations, only 15 crores. So the profits are showing up on paper, but the actual cash just isn't making it into the bank. Now, to understand why that's happening, we need to quickly talk about a metric called debtor days. It sounds complicated, but it's actually super simple. It's just the average number of days a company has to wait to get paid by its customers after it makes a sale. For Jyoti Resins, that number is a shockingly high 161 days. Let that sink in. After they sell their products, they have to wait over 5 months. 5 months to actually get the cash in hand. This is the root cause of the whole issue. All those profits are getting trapped, just sitting out there as IOUs from their customers. So we're left with two completely different stories, aren't we? On one side, you have a growth machine with a rock-solid balance sheet, and on the other, a business that just can't seem to collect its cash. So let's do what an analyst does and weigh this conflicting evidence. All right, let's quickly summarize the bull argument. First, the stock looks dirt cheap. If you take out that huge pile of cash, it's trading at just 11 times its earnings. Second, the owners, the promoters, they're showing massive conviction by actually buying more shares at higher prices. Plus, that huge cash buffer provides a nice safety net, and there's a new factory that could unlock even more growth. Okay, now for the bear case. The number one fear is a receivables blow-up. What happens if all those customers who owe the company money just can't pay it back? The competition is also brutal. The market leader is literally 100 times bigger. And lately, that explosive profit growth we saw has kind of stalled out. And given the accounting flags, there's also a question about the quality of the auditor. Now, to try and quantify some of that accounting risk, analysts use tools like the Benesch M-score. You can think of it like a statistical tool designed to sniff out potential earnings manipulation. A score below -1.78 is generally considered fine. Jyoti Resins comes in at minus 1.52, which flashes a warning signal. Elevated. Investigate.
But, and this is a really important but, you need the context. The analyst points out that this warning signal isn't being triggered because the company is faking its sales. No, it's being triggered by that huge gap between profits and cash, the exact receivables problem we already know about. So the risk here is about liquidity, about getting paid. It's not about outright fraud. Okay, so after weighing all of this evidence, the incredible growth, the amazing balance sheet, but also that critical cash flow problem, what is the final verdict from the research report?
This scorecard tells the whole story perfectly. The company gets really high marks for its strong balance sheet and its attractive valuation, a 9 out of 10 for both. But all that good stuff gets dragged down by a pretty dismal 4 out of 10 for earnings quality. And that's the heart of the issue. The company is cheap and it's financially strong, but the quality of the profits it's reporting is a major concern.
And all of this leads to a final verdict of hold or accumulate on dips. So what does that mean in plain English? Basically, the analyst is saying the company seems too cheap to sell right now, but the risks are just too high to buy aggressively. It's a classic wait-and-see situation.
So what does this all mean for an investor? Well, the report leaves us with a crystal clear dashboard of what to watch. The single most important thing is debtor days. If that 16 one-day number starts to come down, that is a huge positive sign. You also want to watch revenue growth. Will that new factory kick things back into high gear? Can they start converting more of their profit into actual cash? And finally, will the owners keep their own skin in the game? The answers to those questions will be the final word on whether the bulls or the bears win this one.